Hi everybody. I have just been waiting for Jo Tonetti to join us. Hopefully she'll be here very shortly. I just would like to welcome you and thank you for either watching this webinar at a later stage or joining us today to talk a little bit about what smart investors do when things are difficult in the marketplace, and also a little bit about a market update and some information about how we are responding and reacting as well. So we'll get started now, and I'd like to welcome Nigel Barron and Laurie Thorpe, who are on our investment committee, and they able to take questions, and we might in fact ask them a couple of things during the webinar today. So I might just set things out so that everybody can understand, perhaps what's happening in our portfolios, what we've been doing, how the market has affected us, and how we are actually taking that opportunity to improve returns, and perhaps a little bit about how our returns are comparing to the indexes and how we're travelling. It's obviously been a very difficult time for everybody in the last 6 to 8 months or so. The markets were quite volatile leading up to the COVID situation, but have obviously been very difficult. And, we do expect things to be still quite difficult going forward. So what I might do is just perhaps ask Nigel to comment a little bit on how we've been responding to the markets in our portfolios, and a bit of a house view, and Laurie might like to join as well. So Nigel?
Thanks, Carol. Can everybody hear me okay? Yep. You don't have to be a close market follower to understand that the markets are just extremely volatile right now. And there is so much information and optimism that is just bubbling through. And the challenge really is to look through all of the noise. And at the moment, there is a lot of noise, and really not get carried away with it, I think is the number one thing right now. And look, good investing is really boring. It's looking for good companies at good prices that have good businesses. And if there is a market event, yes, you take advantage of any pricing anomalies. But for the most part, at the moment particularly, it's really looking at companies that have strong balance sheets, because there is a lot of uncertainty. There is still a lot we don't know about the next 6 months. So the number one priority is look for companies that have strong balance sheets that we know are going to be around in 6 months' time and prosper when things actually do settle down. So I guess, if you want to summarize it, it's looking for quality and not getting taken away by chasing trends that, can get the market carried away. In terms of, how the market, so much of how our market operates is influenced by what's going on overseas, particularly in the US. And the US is very much, it really has got a lot of sorting out to do. Some of the states are performing really quite well. Other states are just doing very, very poorly. And there's so many mixed messages coming out of the leadership over there. So we're seeing these periods where markets are almost blindly going up, and then we have a reality check, and then it falls by 5 or 6%, and then it sort of carries on going back up again. So it is a wild ride, and we expect this wild ride to continue for some time. Overall, the trend, we're fairly confident, is going to be up, but it's really not getting carried away. It's sticking to the basics, sticking to quality, and taking advantages of opportunities when, the pullbacks do present themselves.
And Nigel, that's a really interesting point, because a lot of super funds and a lot of fund managers out there committed to following what's happening, because they're measured against, different indexes and different benchmarks. And so a lot of large fund managers have to follow what's happening in terms of their allocation, or what they've got in their portfolios based on what different indexes have in them. And that's problematic for, some of the larger fund managers, and it's quite different for us. Would you like to comment just a bit on that for us?
The main index, I guess, in Australia is the ASX 200. And that is simply the index of the 200 largest stocks, broadly speaking, that are listed on the Australian market. Now, this is highly concentrated, and what I mean by that, we look at a market capitalisation, and the market cap is essentially the value of a company at any given point in time, and it's a factor of, you look at the number of shares on issue, multiply it by the share price, and that gives you the market cap. The 6 largest stocks in the Australian market account for about 22 to 23% of the total value of the 200. So that means that the other 194 stocks only account for about 77, 78%. So it's a very highly concentrated market. Now,
and so that means that, you know, a lot of the fund managers are bound to stick within ranges.
A lot of the reality is fund managers get crucified if they have variations too far away from the index. Now, there are some, you know, funds out there that are, you know, benchmark unaware, but the reality is most of them aren't. So if you have a look at the vast majority of Australian funds out there, they're going to have those 6 largest stocks at some weighting. Now, it also just happens that 4 of those stocks are the big 4 banks. So again, about 25% of the market represents banking and financial services. So we're very much a market that is weighted towards those industries. If you have a look at technology, there's only about 3% of the Australian market weighted in that. Now, the way we manage our investments is, you know, we are very happy to, I wouldn't say we totally ignore the benchmark, but we really don't. We're not bound by it. We don't sort of pay homage to it. We look at stocks that we believe, under the current circumstances and the current environment, are going to do well. As I said, the majority of the market is made up of the big 4 banks. In our Australian portfolio right now, we own one of those, and we have a very small holding in that. And the reason for that is that, well, part of the reason for that is, you know, the Australian banks had done phenomenally well for many years. And you know, any stock, no matter how well it's run, how efficient it is, you know, it gets to the point where it's expensive. And then you look at what was happening with the Royal Commission last year, and there was a lot of bad news that the banks came out of that. It was going to make it very difficult for the banks to maintain their profitability, their efficiencies and the dividends. They were going to have to spend a lot of money doing the sort of restructuring that the Royal Commission required of them. And then you add on to that, you know, the situation with COVID that we're in now. It's very hard for banks to lend. Their lending criteria has been tightened up almost daily. And although it's not pleasant to talk about, the reality is over the next 6 months or so, there are going to be people who go bankrupt, who can't pay their mortgages. There are going to be businesses that go bankrupt and close up. So there is going to be significant mortgage default for the banks or loan defaults for the banks. And plus we're in an environment where with interest rates being so incredibly low, banks require, you know, a decent interest rate in order to drive a margin. So their margins are being crushed. And rather than say, oh, well, we'll just take a slightly underweight position to the banks, which is what most fund managers do, we simply say, well, the banks are just not worth owning at this point in time. So we're quite happy to sell out completely.
And I think it's an interesting story because, you know, the topic of the webinar today is, you know, what are smart investors doing? And, you know, on the end of every sale, you know, there's somebody who, you know, potentially is a buyer or vice versa. And I think, you know, the stock that we have in our portfolio, I think you're referring to is at Macquarie, you know, that's an interesting story because we're not locked in to have to hold the index weighting in banks. So we've made a decision. So smart investors make a decision based on the environment and the things that are happening in that sector as to what they do to hold a stock. And in this case, it's an interesting story because we actually didn't have any banks for quite some time, and the price of Macquarie went down so dramatically with the reaction to COVID that it became extremely great value. So we actually purchased it. So that's a really good example of, you know, in a falling market, you'll have people who, or portfolios that are being orientated to take advantage of a circumstance or situation. And so that's a really good example of not being stuck in a big fund where you have to operate in a certain way. We can take a view and we can actively, buy or sell on that based on, what we think is the best outcome for the portfolio. Yeah, so I think maybe we should, Laurie might ask you to just maybe have a little bit of a chat about, how things work for perhaps more conservative retiree type of clients and what we might be doing and how we're considering things in our portfolios as well.
Yes, thank you. Can you hear me okay?
Yes.
Yeah, good. Yeah, perfect, Nigel. Thank you. Yeah, look, I was going to chat around the actual performances and where we've protected the portfolio. So I think that's very pertinent to retirees and that capital preservation focus. So in relation to the banks, for example, we sold out of the banks sometime before the COVID reared its ugly head, and that has saved us quite a bit. Although it has cost us a little bit in the last few weeks as banks are, probably past or seemingly past the worst scenario for them. But we're still, as Nigel alluded to, still reluctant to hold the banks in a very low growth economic condition. So I think from a point of view of like capital preservation or retirees, I don't think it matters significantly that we, it's not the capital preservation focus so much as having been in the right stocks at the right time. And that's, we look at across the board at sort of valuations and in areas that we think will perform in the environment we're looking at in the next 6 to 12 months at the minimum. So I think going in historically for the last 12 months, we've been able to do that, ironically in tech stocks, even though they're, even though they've sort of gone through the roof, like things like Afterpay. We haven't owned Afterpay because of the valuation has never been attractive enough for us to buy it. But we did really well out of Appen. We've done well out of Appen. We did really well out of Technology One. And these are stocks that you wouldn't consider normally in a value-based portfolio. So it's just been able to buy at the appropriate time and the appropriate price. I think also we did well through owning health stocks, which our medical professionals would be familiar with. Did extremely well out of ResMed. We have sold out of it reluctantly, but it became a valuation issue. So we reduced their holding there or sold it out altogether recently. And we've only recently added CSL back to the portfolio. So it's not as valuation wise, it's not as cheap as it has been, but we just see that it's a good stock to hold for the medium to long term. Prices come off. They spend huge amounts of money on research and development. Just today, they announced an investment in a potential cure for haemophilia. So $450 million investment. So they do spend a lot of money on new drugs, this is gene technology. So they are very, and we suspect that'll enable them to grow for a long time in the future. As well as, from a conservative approach, we'll also add infrastructure stocks, which once again is a timing thing, but infrastructure stocks have got regulated income for nice and safe in a low interest rate environment. Will get a good return and pretty stable share prices. Things like APA with their gas pipelines and Spark infrastructure with electricity distribution. And last but not least, we have an ability to hold up to 10% in cash. So that can hold us in good stead during volatile times. So that certainly assisted us during the worst of the downturn. And we've still got a reasonable amount in cash, around the 7%. So we're expecting to be able to put that to use if we do get a second leg of this down market. I think I'm happy to answer any questions in relation to anything in the portfolio. So I'll throw that open to anyone that might have any.
Yes, so if you do have a question, you can just go to the chat box and pop your question in there. While we're waiting for people to think about any questions, I might take the opportunity to talk a little bit about the fact that our portfolios that we run, our separately managed accounts or SMAs in the international and the Australian share area, are very bespoke portfolios, and we are very specific about how we manage those portfolios, and we're looking at our advisors' roles is to decide how much clients should have in cash and how much they should have invested. And so we're not talking about your cash or fixed interest component here when we're managing these SMAs. We're looking at this is for investment. And so our view is that if you have money in our SMA, in the Australian equity or the international equity, that it is invested. And although we do have some discretion around the cash, as Laurie was just explaining, it's the financial advisor's role to allocate money to these portfolios that's for long-term growth. And that's quite a unique way to approach things. And when we're managing the international Australian portfolios, we're looking for that for the long term. So, you know, our clients, we typically have a lot of cash in their bank account or in their offset accounts, and it's not in the market and invested. So none of our clients have a concern about, can I pay my pension payment? Because any money to pay pension payments or to meet short-term requirements is nowhere near any investment portfolio. So when we're talking about managing our portfolios, we're very, we don't start to dilute those portfolios and suddenly we've got 40% in cash or we go off in a direction. We're very focused on the international management of the stocks and the Australian share portfolio management of those stocks. And so our team, Laurie and Nigel, and we do have two external people who sit on our committee apart from myself, and you know, essentially we've got this amazing input from 15 sort of countries around the world on the ground for the international portfolios, coming through our advice, through our connection with AZNGA and Sustante. So we have incredible information coming to us, but we're very, it's very important for you to understand that we are managing those portfolios for you. We're not managing it for 10,000 other people who might range from, you know, 19 years old to 70. We're managing it for people who are wanting to grow their investments for a time frame of 7+ years. And so it's not going to be some kind of generic investment portfolio managed to an index. It's a bespoke portfolio. And, you know, I can actually, you know, looking at our results, and we have been a little bit contrarian with views, and we're definitely not, you know, linked to indexes and things, but we do have some benchmarks that we use to manage our portfolios against, and our returns have been nothing short of amazing in the last 1 to 2 year periods. And maybe Laurie, you might want to comment on that. I mean, I'm quite, as an advisor, you know, I'm absolutely ecstatic that we've been able to give this incredible outperformance to our clients.
Yeah, thanks, Caroline. Yeah, I think in the Aussie SMA, the Australian SMA, like I think for the 3 months, we talked to the end of May, 31st of May, for the 12, well, at least for the 3 months to the 31st of May, you know, we were negative. We were down nearly 3.5%. But the broader market, our benchmark, the broader Australian market was down over 10%. So that's a fairly significant outcome for us and our clients, so the wealth management clients. Over a 12-month period, we were still negative, but we also outperformed the market by 3.5%. So we're really happy with that, and we expect that should continue. This next month or so may differ a little, as we alluded to earlier. The bank stocks have had a bit of a rally. We haven't held them, but I think if we get a downturn, we'll do far better than the market. Over the 2 year period is even more appealing. We've actually on an absolute return of around the 9% return, which is a pretty fair result considering we've come through this COVID downturn, and the broader market is negative 5% over the same time frame. So that's virtually a 14% difference, which I'm sure our clients will be extremely happy with. Internationally, it's very, very, very impressive. 3-month period, we're actually positive, the WealthMed SMA, to the tune of about 3%. The broader market, the world market, ex-Australia, down 1.5% approximately. 12 months, very significant 23% return for the WealthMed SMA versus the world index of around 9%. And then over 2 years, it's pretty, it's very, very good results of a 33% return for the WealthMed SMA versus 13, nearly 14 for the world market. So, yeah, I think that sort of says it all, really.
Yes, and because where we've got clients who are in that accumulation phase of their superannuation or their family trust assets or their personal wealth, when you blend the Australian and the international, which typically for our growth investors, we have 60% Australian equities, 40% international equities. So it's an extremely good result over 1 and 2 years, given just how tricky things have been. And that, of course, incorporates, almost 3 months of quite severe market conditions. So, yeah, and I think this is really answering the question that the webinar was really all about, and that was, what are smart investors or smart portfolio asset allocation and individual stock selection? What is that? What are we doing? And of course, what we are doing is not being bound by very specific, strict indexes and things like that. We're looking at as a real stock picking position, and as a value kind of approach, we're looking for the dividends and looking for the outlook for the fund or for the stock for the future. And then when we blend that together, where those international opportunities are available, our international SMA is a very unique thing that's offered. Very few financial advisory firms have a direct international share portfolio with the scope and access to the exchanges that we do, and I think that that's borne out great results for us. So I guess what we're doing is individually looking at things for you and managing portfolios for you, and we've got a great team of people helping. And I haven't got any questions at this stage, but if there's something that you would like more information on from our portfolio team or from your advisor about the way your portfolio is being managed, we really welcome any emails, phone calls to discuss it. I guess probably that's. Is there anything else, Nigel and Laurie, that you'd like to add, or the rest of the team attending the call, before we wind up for today?
Nothing specifically, other than, I guess set the expectations that, things are going to remain volatile for a little while. We expect it, and nobody likes to see horrible days when the market goes backwards by 2 or 3%. But that is actually just part of the cycle that we're going through, and really people shouldn't get too stressed out about any one day or even 1 week in isolation.
Yes, it can be really tricky listening to the news and the radio, and you're just thinking, oh, what's going on with my investments? And yes, I think there's a lot of noise out there, as you alluded to at the beginning of the call, and the main thing is to hold your strategy, be very specific about what we're putting in portfolios, and make sure that money is being managed for the time frame that you have, and your advisor is going to make sure that you're in the right portfolios for the timeframes that you've got and the income that you're looking for. So thank you very much for joining us on the webinar today, and we look forward to working with you in the future, and we'll certainly be keeping you updated with our webinars about investments and portfolios in the future, should you like to join us.